We have moved into the exponential age where the pace of innovation and change is accelerating. The fact is, there are more technologies that are about to go to the mass adoption phase, groundbreaking, game-changing technologies than ever before in human history. And it's all going to happen over the next 5 to 10 years. And this is really quite extraordinary. My name is Monik Kotecha, and I'm the Chief Investment Officer at Insync Funds Management. Now, Insync is a future-focused specialist global equity manager that invests in a portfolio of highly profitable listed companies globally, benefiting from unstoppable and very significant long-term secular global megatrends. And what we're seeking to do is we're seeking to generate superior investment returns for all our investors. Now, our investment framework, which is depicted in this chart here, is really based on the foundation that over the long term, if you can find great businesses that can generate consistent growth in earnings year in, year out, this leads to a rapidly increasing share price, what we call compound returns. And our focus really is on identifying those really highly profitable, sustainable growth businesses or companies which are on that exponential path. Now, all our businesses need to have all of these key attributes in place before we invest. And that's why we call it the investment framework. It's not just one factor or another. All 4 factors have to be in place for it to be a successful, sustainable growth business. The first one is all our businesses have to be aligned to a global megatrend. And I'll talk a little bit about that a bit later. But that's absolutely fundamental to every stock in our portfolio. And in fact, quite often, many of our stocks have multiple megatrends that are driving it. The second key component is great to find businesses on a long-term trend, but they have to be highly profitable, because that is how you actually generate sustainable compound earnings growth over the long term. The third aspect is that they have to be what we say on the right side of disruption. We know disruption is a major issue today. A lot of companies are being disrupted negatively, and what we want to do is we want to find those businesses that are actually either agents of disruption that are actually benefiting from the disruptive changes that are taking place today. And the fourth aspect is that they all have to be highly innovative. This is the theme of the conference that's going on at the moment, but it's absolutely fundamental to every stock that we own. All our companies typically invest somewhere between 40 to 50% of their cash flows on what we call R&D or innovative spend. And what this does is it ensures that they're on the right side of disruption. They're on the right side of what the next series of products that are going to be accepted by the market. And what it does is it actually future-proofs the business and ensures that they continue to stay on that mega trend. Looking for highly profitable businesses that are aligned to mega trends really gears the portfolio from our perspective to really generate high growth and getting a lot of economic value creation right across our portfolio. Now, we believe there are 3 exponential, really major exponential drivers that are really driving the exponential environment that we're moving into now today. The first one is the significant shift we're observing in demographics. Now, this is a shift that we've never experienced in our lifetime. I mean, there's so many changes that are going on beneath the surface, and you really need to understand those changes because they actually are driving demand for specific products and services. So if you can understand each of those generational shifts, there's a higher likelihood that you're going to find the winning businesses of the future. So if you look at the chart on the left-hand side, when people look at demographic shifts, there's always this focus on the aging population. And that is happening, and we believe is actually accelerating. And I'll take you through an example of a company we have in the portfolio that's benefiting from that aging population. But what's really insightful and interesting is that the number of young people that are making up a large part of the global population, over the next 10 years are going to be the Gen Zers. So this is anyone who was born after 1998. And within the next 10 years, they're actually going to make up the largest population cohort of all the different cohorts that are out there. So that 1.8 billion people. So it's really, really critical to understand what's really driving them. The second key driver, exponential driver, is really the multiple technological advancements we're actually observing today. So you can see here, the cloud, which we're all familiar with. It's really brought down the barriers to entry for a lot of new businesses, and they can scale very quickly and really increase profits at a rate that previous business models were not able to achieve. We've obviously got 5G, and that's now starting to accelerate. I would say 2020, 2021 were defining years for the increase in adoption of 5G, and this will deliver ultra high speeds with significantly greater bandwidth, really allowing a wide array of devices to connect to networks, facilitating the mass adoption of things like the autonomous cars and more effective responses, for example, in emergency healthcare. So it's really going to really speed, I think, things up very quickly and drive a lot of those exponential growth that we're looking for in the businesses that we're seeking to invest in. Another key component here is augmented and virtual reality, and that's really now taking off. And you're hearing concepts like hybrid working environment and the metaverse. What the metaverse is basically a massive communal cyberspace linking augmented reality and virtual reality together, enabling avatars to hop seamlessly from one activity to the next. Now, I'm not going to go into a lot of that today, but if you really want to get an insight into that, look at Facebook's latest and newest metaverse product and how that works in a hybrid working environment. It's really quite incredible to see what's going to happen in the future in terms of hybrid meetings. And then obviously we've got the final key driver, which is the whole concept around sustainability and the move towards net zero emissions. So this is obviously alternative fuels like hydrogen, which has been around a long time, but there's a lot of work that's going into how can you effectively commercialize and create green hydrogen. And there's obviously the whole drive towards carbon capture storage and making that again much more economically efficient. And really the big driver though is the policy shift. These are great concepts, but you need to have an agent, a driver that's driving that exponential growth in that space. And that's obviously one of the big drivers is European Union. They're really committed to bring that down within the next 10 years as part of the Paris Agreement. And this is going to unleash trillions of dollars of new investment in that space. So from our perspective, they're really the three big exponential drivers, and perhaps just touching a little bit more on a couple of them, just to give you a bit more of an understanding as to how important they are. This is a chart of different expenditure depending on your generational cohort. And you'll see here that in 2020, the millennials, this is anyone born after let's say 1980 and 1998, in terms of their spending power, they actually took over the Generation X, which is my generation, which is anyone sort of born after between 1965 and 1980. But what you also got to see, what we call the post-millennials, so this is the Gen Zers, you can see that their spending power is actually starting to accelerate as well. And that's really important because going forward, if you're looking for businesses that are going to benefit from demographic shifts, really understanding the Gen Zers, for example, they're the first generation that have actually grown up with fully grown up in a digital age, and so their perspectives around consumption, their belief systems, are all going to be big drivers of products and services that are very distinct from the consumption patterns and belief systems that the Gen X's had. And I notice that all the time in my children, very, very different views in terms of what they look, how they shop for things, and their views on various aspects of life are distinctly different. And you've got to remember that it is this generation that's creating the future spending power, because as you get older, history clearly shows, the data clearly shows that we tend to spend less. Okay, so you really want to be catering to the millennial and Gen Z zeitgeist. Okay, you really need to understand what's driving them, and that's now taking off. As I said, the Gen Zers are going to be the largest cohort, so they're going to be really critical in identifying the winners over the next 10 years. The other emerging technology now, look at artificial intelligence. Has been around a long time as a concept. It was actually first coined in the 1950s by a person called John McCartney. So it's been around. The concept's been around for pretty much 70 years now, but it's only now taking off. And why is it only now taking off? That's the first reason, is the computing power. We've just seen an incredible acceleration, both in terms of the speed and breadth of computing power that's available out there. So if you look at the fastest artificial intelligence supercomputer today, which is NVIDIA's 2.8 exaflop Selene. Now, an exabyte is equivalent to 1,000 quadrillion bytes. I mean, that's a big number. It's incredible. But that's what's really enabling artificial intelligence now to start taking off. Another key driver is big data. With a hyper-connected digital world, we're now creating more data now than we ever have, and it's growing again at an exponential rate. In fact, by within the next 4 or 5 years, by 2025, IDC, Intelligence Data Corporation, are forecasting we're going to have 10 times more data within 5 years than we had 5 years ago. Okay, so it continues to grow. And so, when you've got companies like Amazon, what does this help companies do? If you look at companies like Amazon, they collect so much data on us as consumers that they can now accurately predict what our next purchase is going to be. Or Netflix, for example, can tell what subscribers what their subscribers are likely wanting to watch next. Okay, so it's just in terms of its impact on society, it's really going to be quite profound. And the other key component, obviously, of artificial intelligence is models and algorithms. And for big data to be effective, you need good algorithms. These are scripts that instruct AI technology what to do. So a really recent good example of all of this is obviously the impact of AI on COVID-19, which has accelerated the use of artificial intelligence in drug discovery. So an international team crowdsourced a COVID antiviral by synthesizing candidates for 2,000 molecules in less than 48 hours. So just sort of reflect on that point. Now, this process would have probably taken 1 or 2 months longer if it was just done by human researchers. So you can just see the speed with which things are moving around. So this is all part of that move towards the exponential age. These are all terrific, exciting, exponential technologies and growth drivers around. And the important thing here is, we're all excited by it, but it's really vital to have a systematic framework to analyze and successfully invest in these changes, to identify the winners and generate the outsized returns I was talking about a bit earlier. Because without a disciplined framework, it is quite easy to get caught up in the hype and really lose significant amounts of capital. And this is what we do at Insync. We try and stay away from the hype and really focus on and making sure we're very disciplined in working out which trends are actually going to deliver those consistent returns with lower risk. So I put this chart up here. It's an old chart. I think a lot of investors will be familiar with the tech bubble in 2000, but it's really quite instructive because we're seeing elements of that in some of the new technologies and exciting breakthrough technologies coming today. So There was a huge excitement in the 90s, as you can see here, in the technology stocks. These were the stocks listed on the Nasdaq. So this is a chart of the Nasdaq Composite Index going back to 1995. And you can see as we're leading into the late 90s, there was so much excited about the internet, despite the fact that there weren't a lot of companies that were actually very profitable. Yes, it was very exciting. We all knew it was about to take off. Everybody was talking about it, and share prices were bid up very, very quickly. So there was a lot of exuberance up there. But when the bubble burst, which is typically happens with a lot of hype cycles, then investors lost 70 to 80% of their capital. Okay? So it's just good to have this perspective in mind when you're looking at a lot of those new emerging technologies today. So one of the frameworks we use, this is the Gartner hype cycle, and it's a very useful framework to think about where the technology is in terms of adoption and profitability. Because as I said, you really want to try and avoid the hype phase. Now you could get involved with that, but you've got to realize the risk and return profile is very different. It's much higher risk, obviously commensurate with higher return. But as I said, in the tech bubble, if you get it wrong, you can lose 70 to 80% of your capital. Sorry. So what you want to avoid is this section here. Okay, this is the hype area. So these are technologies today like genomics or battery technology, even artificial intelligence to some extent sits in the hype cycle. It is very exciting. It is taking off, but it's still in the early phase in terms of identifying who the clear winners are. So we try and stay away from this area. And what we do is we focus, because a lot of these trends do actually end up becoming megatrends. So the internet started in 2000, but it took a full 15 years before we were really starting to understand or identify companies that were clear winners of that spend that we saw 15 years earlier. Okay. So some of these trends, genomics, artificial intelligence, will actually become mega trends. But if you're in the high phase, it's really hard to work out who the winners are. So you want to be past the high phase when there's a period of disillusionment. A lot of companies leave the industry, and the mega trend is still very much in place. But what you end up with is you start to get higher levels of adoption rates, and you start to find out who the winners are going to be. So, for example, we've recently invested in a leading player assisting older patients with non-invasive heart surgery. Okay, now this has been 12 to 15 years in the making. So this was very much at the innovation stage in the early 2000s. Adoption rates were very low, so we were probably around here in 2000. But when we look at it in 2020, the adoption, that technology is now being commercialized, is being increasingly adopted, and companies are now trying to generate very high levels of sustainable growth. So from our perspective, when we look at it today, investing in the heart is a more assured way of increasing your wealth and health than in genomics today, even though genomics is obviously a very exciting technology. So megatrends. So megatrends is the core of really what we do at Insync. What megatrends are, they're very large, durable, and unstoppable, and in the right side of disruption. So you can almost set your watch by it. So if you look at the aging of the world population, the move to digital payments, or the drive towards improving health and fitness, these are not impacted by economic cycles. They just keep moving along just like a giant, colossal tidal wave. They're unstoppable, they're large, and they just keep on moving forward. But we don't need to concern ourselves with correctly trying to forecast what the economic growth rates are going to be over the next 12 months to work out how to best position the portfolios, because we're invested in those profitable companies benefiting from these megatrends. So what we do at Insync is, it's about identifying the megatrends. It's evaluating the potential size of the next 10 years, finding the most profitable companies. I can double underline, it is so important. Great to find a megatrend, but you've got to find the economic beneficiaries of that trend, and correctly valuing them is really what we do in terms of finding the future winners. Okay, that's our competitive advantage. Now, what you'd observe looking at this chart, we've got 28 stocks across these 16 global megatrends. And there's a really nice combination of both technology megatrends. I mean, we live in a technological world where things are moving very quickly. Artificial intelligence, 5G, cloud computing, work automation using technology, augmented reality. So those data analytics. There are very profitable businesses that are on that exponential trend. There's exponential megatrends, but there's also a nice mix of non-technology megatrends. You don't to invest in future growth and secular trends and find highly profitable compounding businesses. You don't just have to be in technology. There's a lot of exciting non-tech trends here. So if you look at one that it's an important part of our portfolio is the pet humanization global megatrend, which is one where we're increasingly treating pets like humans. Now, interestingly, that fits in with the demographic shifts, because what we're seeing is we're actually seeing an acceleration in pet adoption and pet spend, and that's really principally been driven by the Gen Zers. So that gives us a lot of confidence, and the businesses that we own are just incredibly, insanely profitable. And so we're seeing the growth rates there at almost 3 times GDP. The amount of pet spend is actually growing at 3 times GDP. And we can see that happening for the next 5 to 10 years. The increased trend towards health and well-being. If anything, that's come to the fore of the global population is the importance of health. We're going through obviously a major crisis in COVID-19 here. So that's been a major accelerant. And then there's obviously the food away from home market. There's increasing amount of food that, in terms of takeaway food that we've been consuming, and that actually the amount of spend on takeaway has actually had increased at a level that's actually higher than the food prepared at home market. And this sort of happened 7-8 years ago. There's a lot of different drivers there, but that's a trend again that's been growing in multiples of GDP. And again, we've been able to find some outstanding stocks that benefit from that mega trend. So in Insync's portfolio of 16 sort of technology and non-technology global mega trends, what that does do for the investor is actually provide some really powerful diversification benefits. A really useful place, in our opinion, to have in your portfolio. So just to give you a couple of case studies, just to illustrate or give you ideas about what we've invested in the portfolio. So again, a non-tech megatrend. So the aging population has been a concept that's been around for a while, but really one needs to understand how quickly the world is aging. So if you look at the bottom chart here, what you'd observe there is that the trend line in the over 70s is actually starting to accelerate. So yes, we know there's an aging population, but we're actually aging at a much faster rate today. And one of the, if you look at the top chart here in terms of the leading causes of deaths in the over 70-year-olds, it's actually cardiovascular disease. It's the heart disease. In fact, that's the leading cause of death generally, but particularly in older populations. You can see by a significant margin, it's the leading cause of mortality within that age cohort. Now, the real challenge there is that it's a really dangerous procedure to have open heart surgery in the over 70s. Okay, there's huge amounts of risk involved, and obviously with COVID-19, even getting to the hospital has been very, very difficult. So one of the technologies that's emerged, which I spoke about a little bit earlier when I was talking about the hype cycle, was a non-invasive procedure for heart surgery, which is called a transcatheter procedure. It's been 20 years in the making, and the company that we own there in the portfolio is Edwards Life Sciences. They're really one of the pioneers in the technology. And what we've seen is the adoption rate of that technology actually starting to accelerate. So here's a company that spends a huge amount of R&D, in fact, twice the level that its competitor does. It has 40 to 50% market share. And as you see, as the over 70-year-olds cohort starting to accelerate, we believe that the demand for the product will also accelerate. And again, it's just a very, very profitable business. We measure it using a term called return on invested capital. So it's the amount of capital that goes on the business, and it's the return they get on all the capital that goes in the business. And across our portfolio, the average return on capital is 50%. Okay, if you compare to the average of the market of 10%, our portfolio in terms of profitability is 5 times the market average. So we're really, this is one of the 28 stocks we have in the portfolio. To give you another example, so this is, I suppose, more in the technology space. And 2020, 2021 was really a watershed here, a year for 5G. The number of licenses that were bid for in 2020 by telecom companies, telecommunication companies around the world was in excess of $100 billion to US dollars to get those licenses. And now they're starting to rapidly deploy the infrastructure. And what this will facilitate is the Internet of Things. So this is where devices connect with the network. So this facilitates obviously the autonomous cars or factory automation, or a much more efficient and faster responding healthcare system. So it really is going to be really quite incredible in terms of its impact it's going to have on all of us. And you can see from the bottom chart here that the number of devices that are expected to be connected as a result of 5G is going to double to over 40 billion devices just within the next 4 to 5 years. Okay, so again, the exponential growth is coming through, and again, we've got a number of investments that are going to benefit from this trend because we can see it happening today. It's accelerating. They're clear leaders in that space that we've identified. They're incredibly profitable, generate very high returns of capital, and so we have a number of these investments that are really positioned to benefit from these trends over the next 5 years. And the important thing is we don't need to sell any of these stocks. They're, if you look at a company like Qualcomm, which is one of the companies exposed, they're the company that have basically created, the 2, 3G, 4G, 5G platforms. So, if you want to participate on that, you've got to give them a license fee. And again, insanely profitable with a large addressable market to go into. So we're very excited about the 5G megatrend. And again, it's one of 60 megatrends across our portfolio. So as I said earlier, identifying the megatrends, evaluating the potential size of the next 10 years, finding the most profitable businesses and correctly valuing them, the select group of winners is really a competitive advantage. And you can see here when you look at our performance numbers going back over 1, 3, 5, and 10 years as to the benefits of this approach. Okay, you can see you can generate very 15-20% returns is what we've achieved over the last sort of 5 to 10 years fairly consistently by focusing on the megatrends. And as we move into this exponential age, what we're observing is that many of the trends that we've had in place for a while pre-COVID, some of them are actually accelerating. And so we're finding those businesses that are going to be generating that significant earnings growth. And as I said to you earlier, if you can find businesses that can generate sustainable, significant earnings growth year in, year out over the next 5 to 10 years, then you get really, really attractive share price appreciation that follows that earnings growth. So please reach out if you would like to find more about Insync, and I really appreciated the time you spent listening to me in taking you through the investment approach to investing in the exponential age. So thank you very much.